AMMB Holdings and MetLife International Holdings are proposing to divest their jointly owned insurance and takaful businesses to Singapore's Great Eastern Holdings for approximately 1.12 billion ringgit. Great Eastern is a unit of OCBC Bank. AMMB's wholly owned AMMB Holdings owns 50% minus one share in MetLife Insurance and 50% plus one share in MetLife Takaful, with the remaining stake in both units owned by MetLife. The plan is for Great Eastern Life Assurance Malaysia and Great Eastern Takaful buying 100% share capital in MetLife Insurance and MetLife Takaful. Post-acquisition, both MetLife Insurance and MetLife Takaful will be merged and integrated with Great Eastern Life Assurance and Great Eastern Takaful, respectively. According to AMMB's boss filing, the proposal will also see these four insurance units entering into exclusive 20-year bancassurance and banca takaful agreements for the distribution of life insurance and family takaful products through the distribution network of AMMB's banking subsidiaries. In a statement, AMMB Group CEO Datuk Sulaiman Muhammad Tahir said that the synergistic integration will provide the bank with the advantage of securing economies of scale that will translate into superior customer value, enhanced by its combined and complementary capabilities in product design, digital innovation, and distribution expertise. According to MetLife and MetLife's websites, their strategic partnership can be dated back to April 2014, when MetLife took up half of the shareholdings in M Life Insurance and M Family Takaful at a price of $812 million or $249 million US dollars. The proposal is subject to, amongst others, the prior written approval of Bank Negara and or the Minister of Finance and the Monetary Authority of Singapore. The World Bank reduced its forecast for Malaysian economic growth as measured by gross domestic product to 3.9% this year from 4.3% projected previously, amid substantial deceleration in external demand. However, the bank raised its 2024 projection for Malaysian GDP to grow 4.3%, up from 4.2% previously, according to its East Asia and Pacific October 2023 economic update published on Monday. Lead economist from Malaysia, Dr. Apurva Sanghi, said the country's economy is expected to be driven by recovery in global growth, the tourism sector, and anticipated higher oil prices. He explains that the economy is expected to face significant external risks and that deeper global growth shocks could potentially result in a more significant slowdown than anticipated. Sanghi said the base effect also plays a role in the World Bank's GDP's growth forecast, given that the country's economy rebounded 8.7% last year, so expansion is projected to moderate in 2023 before accelerating in 2024. As the economy continues to grow, Sanghi said it is expected that poverty and income inequality will further decrease, provided that it is accompanied by policies that enhance inclusiveness. Meanwhile, the bank says that Malaysia's economy is required to open its services sector like digital, legal, accounting, logistics and transport in order to continue attracting both foreign and domestic investments. Sanghi points out that Malaysia's investment to GDP ratio has been consistently coming down since the Asian financial crisis, from a high of over 40% of GDP to below 20% today. He adds that proactively liberalizing services will remain key in boosting Malaysia's investment and New Industrial Master Plan 2030's success story execution. Pay TV provider Astro Malaysia Holdings announced that it will close down its home shopping business under Go Shop from October 11th, citing challenging overall economic landscape and the changes in consumer shopping behavior. In a statement, Astro elaborated that there has been a significant downturn in this mode of shopping since the COVID-19 pandemic, and closure will ensure that the group's resources are focused on business lines that contribute the biggest difference to the overall operations. Astro and its Korean JV partner GS Retail have decided that Astro GS Shop, which operates the home shopping business, will cease operations beginning October 11th. It is noted that Go Shop is not considered a material subsidiary of the group and is not expected to have a material effect on the group's consolidated EPS and net assets per share or gearing for the financial year ending January 31st, 2024. Go Shop started in 2015 as Astro's first foray into the e-commerce domain, enabling Malaysians to shop anytime, anywhere 24/7 24/7 and is also present in Singapore and Brunei. According to Astro's 2023 annual report, the group had fully impaired its cost of investment in Go Shop, amounting to 48.1 million following the subdued consumer sentiment, changes in consumer behaviour as customers return to physical stores, and continuing losses during FY 2023. Budget 2024, which is slated to be tabled in Parliament next week, will be a prime opportunity for the government to undertake fiscal consolidation reforms to avoid running off a fiscal cliff. With the growing burden on Putrajaya's coffers, Socio-Economic Research Centre Executive Director Lee Heng-Gui said, Budget 2024 serves as a window of opportunity for the government to unveil a measured pace of fiscal reform so that the following years running up towards the 16th general election can be utilised to quell discontent from voters over unpopular policy moves. Lee said it is crucial for the government to come to political sense and economic sanity to avoid a fiscal cliff, namely conflict over constant increases in the debt ceiling due to an unsustainable budget deficit as seen in the US currently. In view of this, Lee foresees that Budget 2024 will focus more on operating expenditure and will be characterized by the introduction of necessary but unpopular measures, including targeted petrol subsidies, as well as scheduled implementations of the previously announced capital gains tax on non-listed shares and luxury goods tax. Lee also notes that a reform of the civil service must be done to improve the quality and value of public services-based performance and productivity-linked salary systems. Towards this, he shared his disagreement with the government's previously announced plan to detail a civil servant salary rise in Budget 2024, as he said things of this nature should only be done until the ongoing comprehensive study of salary and retirement schemes is completed in 2024. Another of Lee's hopes for Budget 2024 is a 12-month pre-announced reintroduction of the GST at a lower introductory rate of 4 to 5% compared with 2015's 6% towards addressing the nation's unsustainable tax base. Shares in Baustet Plantations fell as much as 27 cents or 18.5% in the morning session ahead of the second cut-off date of October 6 for the proposed acquisition of the Armed Forces Fund Board-owned group by Kuala Lumpur Kepong. BPlant was among Bursa Malaysia's topmost active with over 46 million shares traded as the counter ended Monday 13% lower at RM1.27. Following the steep decline, Bursa suspended its proprietary day trading and intraday short selling of BPlant shares for the rest of Monday. The sell-off sparked concerns that KLK's acquisition of the plantation group could be facing hurdles. Both KLK and LTAT declined to comment when contacted. The cut-off date for the proposal was first extended to September 22nd from the original September 11th deadline. It was then extended again for another 2 weeks to October 6th. The deal has been in the spotlight as opposition leaders claim that the deal does not fit with the government's aim of achieving the Bumiputra corporate equity target of 30% by 2025 as underlined in the 12th Malaysia Plan. In response, Defence Minister Datuk Seri Muhammad Hassan said that during the bidding process, Tradewinds Corp, controlled by Tycoon Tan Sri Said Mokhtar Al-Bukhari, was the only Bumiputra company that had ultimately submitted a bid which eventually turned out to be too low.